Are you thinking about buying a convenience store in Canada? You could be walking into a $500,000 trap or a $200,000 year-end cash machine. Well, the difference? Most people look at the numbers wrong. I'm Lakshay. I'm a CP who has analyzed dozens of convenience store deals across Canada. The market is $11.3 billion, but store counts are dropping by 1.3% annually, which means bad operators are getting crushed while smart buyers are consolidating. I've seen buyers lose their life savings on stores with fake revenue numbers and many other Mickey Mouse deductions that others might have claimed. And I've also seen others triple their investments in 18 months by asking the right questions before signing. You'll actually learn how to analyze a convenience store. We're going to talk about its revenue streams. We're going to talk about qualitative filters like location, competition, lease terms that kill the deals. We're going to talk about quantitative analysis like the financial ratios that separate the winners from the disasters. We'll also talk about real examples like two actual stores for sale analyzed side by side with real numbers. Then we're going to talk about tax document review, what to look for in financial statements and how to catch fraud. Finally, we're going to end off with a recommendation. Should you actually buy one, or is this a terrible idea? Hit subscribe right now. I post real business analysis and tax strategies weekly that most accountants charge thousands for. First, let's break down where convenience stores actually make their money. So most people think convenience stores make money by selling chips and pop. Wrong. The real revenue model is way more complex, and if you don't know or you don't understand where the money comes from, you'll actually end up paying or overpaying for a store that can't sustain itself. Let me break down the 6 revenue streams. So number 1 is lottery. Lottery is a silent profit engine and most buyers completely underestimate it. According to the Canadian Convenience Stores Association, lottery sales generated $2.38 billion across convenience stores in 2018. Convenience stores capture 65 to 78% of all lottery sales in Canada, depending on the province. Number 2, cigarettes. Cigarettes used to be the king. Now they're in a declining empire. Tobacco products still generate largest product category share in convenience stores, but margins are razor thin at 8 to 10% according to the industry data. Here's what smart buyers look for. Is the store's revenue overly dependent on cigarettes? If 60% plus of sales come from tobacco, you're buying a declining business. You want diversification. Revenue number 3, candy, drinks, and sodas. This is where margins actually exist. So 30 to 40% of gross profit is in beverages, candy, and packaged groceries, energy drinks, premium coffee, craft sodas. They're all like high priced items with better margins. So what to look for? Gross profit percentage on categories should be 35 to 40%. If it's under 30%, the store has pricing problems or theft issues. Stream number 4, car and smoking accessories. This is a supplemental category where you sell phone chargers, lighters, vape products, car air fresheners, even smoking accessories. The margins are decent in this. They're 25 to 35%, but volumes is unpredictable. If a store shows huge accessory sales, but you can't see the inventory or receipts, it might be cash-based or unreported revenue. So it basically disappears the day you take over. Stream number 5, ATM, money transfers, and other services. ATM fees, Western Union, lottery terminals, propane exchanges, these all add up. According to CCSA data, ATM fees contribute about 6% of the gross profit for stores that have machines. Stream 6, alcohol. This is the newest and potentially the biggest opportunity. As of September 2024, Ontario convenience stores can now sell beer, wine, cider, and ready-to-drink beverages. This is massive for the industry. The margins, typically 20 to 25% on alcohol, which is better than the cigarettes and comparable to beverages, but there's a catch. Licensing requirements and compliance costs and inventory investment. You need a cooler space, security, and 10 to 30,000 in initial alcohol inventory. But revenue means nothing if the location kills you, the lease bleeds you dry, or you need to renovate everything the day you take over. Here are 9 qualitative factors that you need to consider. Location. The only thing that matters is demographics, traffic, visibility, and accessibility. High foot traffic areas like near hospitals, residential zones, or workplaces, they often win. Stores in declining neighborhoods or behind buildings with no visibility, you should pass immediately. Number 2, Rent expense, the silent killer. Rent should be 8 to 12% of the gross revenue. If the store does $50,000 a month and pays $8,000 in rent, that's 16% and it's unsustainable. Number 3, mortgage cost if you're buying a building. Most buyers lease, but if you're buying a property too, mortgage payments should not exceed the market rent would be. Otherwise, you're overpaying just to own real estate. Number 4, hours of operation, your life or your business. Most convenience stores operate between 6 a.m. to 11 p.m. or 24/7. If it's 24 hours, you need employees and you'll work yourself to death. Number 5, solo or employees required. Stores under $30,000 a month can often run solo or with family. Above that, you need employees. Factor in $15 to $18 hourly wages plus payroll taxes. Number 6, best performing months. Summer usually peaks, which drinks, snacks, and lottery. Winter usually dips with 15 to 20% depending on location. I would technically go as far as requesting 24 months of sales broken down by month. If the seller only shows average monthly sales, they're hiding seasonality. Number 7, renovations or repairs. Hidden costs waiting, roof leaks, broken coolers, cracked parking lots, faded signage. These eat like $20,000 to $50,000 fast. So before you buy, get a building inspection. I would recommend estimating the deferred maintenance and deduct it from your offer price. Goodwill. Number 8. Goodwill is intangible value. Brand, reputation, customer loyalty, established supplier relationship. Most convenience stores have zero goodwill. Customers shop based on location and price, not loyalty. If seller is charging like $100,000 for goodwill, demand proofs like customer retention data, repeat purchase rates, online reviews, otherwise negotiate it down or walk. Number 9, equipment rentals, the hidden monthly drain. Lottery terminals, ATM machines, POS system, they are often rented, not owned. So check monthly rental costs and whether you can renegotiate or buy them out. Some sellers hide $1,000 to $2,000 a month in equipment leases that kill profitability. These are soft factors that determine whether a store can actually survive in the long term. Most buyers ignore them and regret it 6 months in. But if the numbers don't work, nothing else does. Let's break down 6 financial metrics that separate a real business from money pits. Number 1 is gross sales and profit margins, the foundation. Target is 25 to 35% gross profit margin industry-wide. A store doing $600,000 in annual sales should generate around $150 to $210 in gross profit. Highest margins. Fountain drinks, which is 60 to 80%, coffee 70 to 80%, candy and snacks 35 to 40%, lottery 100% commissions. Lowest margins, which is cigarettes 8 to 10%, milk 15 to 20, newspaper 5 to 10%. The trap, the stores that sell high volume of low margin products look busy but barely break even. You want high margin product mix. Number 3, distribution of sales by product. Diversification check. No single category should exceed 40% of sales unless it's a high margin item. So here's a balanced mix. So you can do 25% in drinks and snacks, 20% in groceries, 20% in cigarettes, 15% in lottery, 10% in accessories, and 10% on alcohol. Number 4 is inventory. Inventory should turn 12 to 18 times annually with every 20 to 30 days. We have the formula written down for you. If the inventory turnover is like 30 plus, it's too high. You're running out of stock, losing sales. If it's too low, which is under 8, cash is trapped in slow moving inventory. Number 5 is retail versus wholesale, catching fraud. Most convenience stores are pure retail. If the seller claims significant wholesale revenue, you should verify it. Why? Wholesale has lower margins and requires completely different operations. Sellers sometimes inflate the wholesale numbers to boost their top line. You should demand wholesale customer lists, invoices, and delivery records. If they can't produce it, it's fake. Number 6, monthly expenses, the profit killer. Target around total operating expenses under 20 to 25% of gross sales. Break it down. Rent should be 8 to 12, labor should be 8 to 12, utility should be 2 to 3%. Insurance and licenses and miscellaneous 2 to 3%. If expenses exceed 30% of sales, the store is actually unprofitable unless you can cut costs immediately. These numbers tell you whether a store can actually make money or whether it's been surviving on luck and fake accounting. But the theory is useless without real numbers. Let's analyze actual convenience store for sale in Canada. I'll walk you through the financials, apply every filter we have covered, and tell you whether this is a buy or a pass. Let's look at the numbers. Store number 1, the monthly gross sale is roughly $89,000. You take out HST, it's roughly $79,000, which leaves you to around $20,000 of weekly average. So far, decent volume. But revenue means nothing without profit. Let's break down the income. So gross income breakdown. Cigarettes is roughly 62% of the sales, which is $49,000 a month. Other products is roughly 38% of the sales with 40% margin. So total profit from sales is roughly $16,906. Lottery commission is another $6,700. So total gross income is roughly $23,000 and change. If I were to analyze this, the first red flag is the 62% cigarette dependency. This store is heavily reliant on a declining low margin product. One regulation change crushes this business. Let's see where the money goes. Property tax, which is roughly $636 a month. Hydro, which is $800 a month. Insurance is roughly $600 a month. And other expenses roughly $362 a month. Internet is another $100 and bank charges another $100 a month. Accounting is roughly $167 a month. There's a security fee, which is $35 a month. So total monthly expense is roughly $2,800. But wait. Where's the rent? This suggests the owner also owns the building. So there's no rent expense. So if you're leasing, add another $5,000 to $8,000 a month to basically rental expenses. It's also missing labor costs. This assumes a solo operation or a family-run business. If you need employees, add another $4,000 to $6,000 a month. Total gross income is $23,000 roughly. Total expenses is $2,800. Net income is $20,800 a month, or $249,000 a year. Sounds amazing, right? But hold on. This assumes you own the building, no rent. You work solo or with an unpaid family member, which is no labor cost. Sales stay consistent, no decline. No major repairs or renovation. If you're leasing and hiring staff, add another $6,000 in month, add another $5,000 in labor, the net income drops to roughly $9,800 a month. It's still profitable, but way less attractive. Let's look at example 2, double the sales volume. Same filters, different number. Let's see if bigger is actually better. So in this one, the monthly gross sale is roughly $195,000. The net sales is roughly $173,000 if you take out HST. Weekly average of $45,000. Immediately, this is a 2.2x on revenue, which means more revenue means more profit, right? Not always. Let's break it down. The gross income over here is mainly from cigarettes, which is 95% of the sales, which is $173,000 roughly. With a 5% margin, that leaves you roughly $8,200 a month. Other products, only 5% of sales, which roughly brings you to $8,600 a month, and a 35% margin means $3,000 only in net profit. Lottery commission is another $15,000 a month. Other income is another $1,950 a month. So the total gross income is roughly working out to $28,000. Massive red flag is the cigarette sales, which is 95% of the sales. If there's a one tax increase or a regulation change, that's gonna kill the entire business. Monthly expenses. Rent is $5,300. Maintenance and insurance is another few $100. Other fixed expenses is roughly $1,000 a month. Hydro, internet, security, insurance, accounting, and other like bank fees. All of them will add up to roughly $6,300 a month. Notice, there's still no labor cost listed. This assumes that you are a family or a solo operation. So you need to add another $4,000 to $6,000 a month if you need staff. Net calculation. Total gross income is $28,000. Total expenses is $6,300. Net income is $21,000. Or you can do $262,000 a year. So on paper, $1,000 a month better than example 1. But hold on. With employees adding another $5,000 in labor, the net income will drop to $16,000. It's still strong, but look at the risk profile. Example 2's profits depends on 95% cigarette sales remaining stable, declining 1 to 2% annually. $15,000 a month lottery commission, 53% of the gross income. Solo operation, staff kills margins further. One government regulation change, plain packaging, flavor ban, or a tax hike, and this business will implode. The high lottery commission masks terrible fundamentals. We've analyzed the two stores. Now let's compare them side by side and determine which one actually wins. Example number 1. The net sales is $79,000 a month. Cigarettes is roughly 62% of sales, which is a red flag but manageable. Gross margin is 21.4%, which is below target but acceptable. The net income is $20,806, which is so low, but if you add rent and labor, it's going to drop by half, which is $9,800. The risk is moderate because of the cigarette dependency. In example 2, you can look at the sales, which is $173,000 net sales. The cigarettes is 95% of sales, catastrophic red flag. Gross margin is below, which is almost 4x below the market. Net income is roughly $20,000, $16,000 if you add labor. The risk is extreme because of the lottery dependency and cigarette dependency. So what is my final verdict? As a CPA, I would say the example 1 is better buy because despite the lower sales volume, it has a better product diversification, it has higher gross margins, lower regulatory risk, and more room to improve by adding alcohol and high margin snacks and prepared foods. Example 2 is a ticking time bomb. 95% cigarettes, one regulatory change, and you can see bankruptcy. If I was forced, I would choose example 1. So example 1 wins the comparison. But here's the real question. Should you buy either one? The answer, only if you follow these 4 non-negotiable rules. Miss even one and you're walking into a money pit. Rule number 1, verify the traffic and sales. Visit the stores for 30 consecutive days and manually count the number of walk-ins. Why? Because sellers usually lie about the foot traffic. They'll show you they're busy weekends and hide slow weekdays. Track peak hours, 7 a.m. to 9 a.m., 12 to 2, and 5 to 7. Weekend versus weekday traffic. Customer demographics, students or professional or families. Rule number 2, lottery commission must cover rent. The lottery commission should equal or exceed your monthly rent expense. Why? Lottery generates pure commission income with zero inventory cost. If it can't cover your biggest fixed expense like rent, the store is structurally unprofitable. Rule number 3 is diversified revenue streams. Don't buy cigarette dispensaries disguised as convenience stores. Add these additional income options. Propane exchange, beer and wine sales can be added. Money transfer services can also be added. And even fax and copy services can be added for a steady but small income. This buffers you against cigarette lottery declines and creates multiple revenue pillars. Rule number 4. Run the numbers with the worst case scenarios. Don't trust the seller's average monthly sales. Demand 24 months of sales data broken down by month. POS report should also be requested. Even request expense receipts like rent agreements, insurance agreements, and even payroll. Inventory records is also an important aspect to verify the cost of goods sold. Most convenience stores in Canada are barely profitable once you factor in owner's labor. If you're working 60 hours a week to make $10,000 a month, you're not effectively paying yourself even a minimum wage. Convenience stores work financially if you own the building. No rent bleeding, it's family run, no labor costs, location has high foot traffic and minimal competition. You can add high margin services like alcohol, propane, money transfers to bring it more profitable. You're buying at a reasonable multiple of 2 to 3x annual net profit max. If you can't check all 5 boxes, you're better off investing elsewhere, like 3D printing business or mobile car detailing, or even an Airbnb cleaning business. We have covered all of these 3 in the past, so check out those videos as well. If this analysis saved you from bad purchase, hit that like button. Subscribe for more business breakdowns. I analyze real opportunities with real numbers so you don't waste your money on bad deals. If you have any question, ask in the comment sections, and please don't go buy blind. Do the math, verify everything. I'm here to help you if you get stuck. Thanks and have a good day.